right, good morning to all of our listeners today. We're talking about what we're seeing in the market, Q1 2025. It's definitely been kind of an overall bullish sentiment, but not without some very choppy seas. So today for the conversation, we have Randy Barkley, Jeremiah Lee, myself, owners of Tricord Advisors and certified financial planners. We also wanted to bring in a heavy hitter, Dr. Jason Thomas. He is a trusted investment partner and advisor with us here at Tricord Advisors. He's got his PhD in economics from USC and master's from Stanford. So a lot of brain power coming at you today. So let's go ahead and dive in. I want to just address for some of our listeners, what are some of the highlights that we're seeing in terms of overall market performance this first quarter?
Yeah, that's a great question. I think for a lot of people, when they look at their portfolios, it feels flat, it feels down. I remember being up, but I feel down now. I'm not sure where I am. And from the first of the year, I mean, I think a lot of folks are generally where they were. You know, they went up for January, they came down. I mean, all portfolios are a little bit different. But the road, man, it has been up and down. We've had some really big down days, a couple of up days that made us feel better. But I'd say, February forward, most people, I think, are feeling some pain, feeling some uncertainty, feeling some risk. I have thoughts of why and how, but we'll save that for a little later. But Jason, what are you seeing? What are you seeing in portfolios, for the year so far?
Seeing and hearing from advisors and clients. On the positive side, bond allocations are doing well this year. That was really painful in the last quarter of last year, was when what you thought was your safe money was losing value. Interest rates have come down, and so bonds have done well this year, and so that's on the plus side, especially in terms of just the feelings and the anxiety. On the downside, the individual stock volatility has been very high, and so if you're someone that reads the paper or you look at CNBC, what you're seeing in terms of 8% moves, 10% moves is a lot bigger than the actual move in your portfolio. That and the kind of the uncertainty about what's happening, I think that's adding to the anxiety, which is far beyond the actual movement in people's portfolios, which, as you said, has not been that much this year.
Right.
And I can mirror that, because as I meet with clients, what they bring in is an emotion, and I can almost tell exactly who they listen to by the first questions that come out of their mouth or the comments. And then when they look at their portfolio, they go, "Oh." I mean, we met with somebody yesterday, Jason, just to give you an idea. He went golfing with a friend in Las Vegas, and the friend said, "I lost 52% of my portfolio value since January."
That's because they had two major holdings, right? So we weren't well diversified.
So we came down, we sat down, did a review. He says, "Oh, I'm off less than 2%. I feel pretty good about that." But you could tell where he was getting his general information from, and the concerns about, Trump, tariffs, whatever, all the stuff that's out there. But if it bleeds, it leads, right, Jason?
That's right. That's right. So important for people to stay on track, not only in terms of what's happening with their individual portfolio, but also how that plays into the larger plan, which is, of course, why it's so valuable to do the financial planning that you guys do. You got to know where everything fits relative to what it is that you're trying to accomplish.
Right. It also seems to me such an extreme sentiment. I mean, I keep hearing we came off a fantastic year of returns last year. Most people were experiencing that. And, then all of a sudden this sentiment shift, we swing the opposite end of the pendulum. We're talking about recession. It's dim and dire out there all of a sudden. And it's like, well, there's indicators that lead us in that direction that we're looking at. But certainly a lot of the conversation is just kind of, okay, hang on, let's take a breath and look at what we do know and what we can glean from what we've seen over the last quarter. So.
Yeah. And I love even just this part of this conversation is the partnership we have with Jason and his fantastic company, as we're talking through the emotions with our clients, this is what they're feeling, this is what they're sensing. Jason and his team, they're on the backside, making sure that the best items are in the portfolios, making sure that the bond and equity allocations, as well as the various sectors, making sure that's as good as it can be in the moment. And that it's not just reactionary, but it's long-term focus. And so it's part of making sure that the math and all the elements of the portfolio are as the best they can be, but then communicating that in a way that kind of deals with that. Like you said, Laura, if it bleeds, it leads. The news, the media, what people are having to contend with. And when there's sometimes, I think with people just staying the course, is a huge amount of value. And Jason's the one driving the course in the sense of what's in the portfolio, but we're keeping them in the boat to say, yes, this is still the best place to be. This is still a great option. Let's continue for the long term. And so we tell a lot of our clients that the emotions and the math, like they both matter, but it's different. Different clients lean more towards the math. Most of them, I would say, lean more towards the emotions. And we have to kind of walk through all that.
Yeah, let's break it down a little bit. Jason, what do you find are the notable sectors that are driving kind of this bullish momentum in the market?
Well, maybe I might start with what's driving some of the bearish momentum in the market,
Sure.
which is, of course, technology. And we came into this year in a vulnerable position in the sense that the technology stocks, the high flyers, they were very expensive, and they were the markets were very concentrated, so they got very big, and so at the index level, there was a lot of movement that was just generated by those stocks. I think the Magnificent Seven, those big 7 technology stocks, generated about 25% of the S&P return last year.
And so we come into
that's
that concentration, right? I mean,
that's right. We come into that with a big risk, and so and so much of the value of those companies is in the distant future. We got to remember, when you buy a share of stock, or if you're an entrepreneur and you're thinking about the value of your business, it's forever, right? At least that's the way we think about it and value it. And so small changes now can have a big impact on the value of something. And so when there was some uncertainty in January, we had a pretty good January, but towards the end of January, that uncertainty came in. And so that really caused a significant downdraft. And there was a big rotation in the market from the high growth areas to the defensive areas, the healthcare and even utilities and real estate. And so now what I think we need to do, because what we've started to see is that there is not a clear path forward, right? We thought there was a clear path A, then
right.
No, it's a clear path B, and now we're like, no, we don't know.
And let's just sprinkle on a new administration just right on top of that. So yeah,
one
that happens to be a little polarizing. Yeah.
And so what diversification means, I think practically speaking, is that you have a spread in the portfolio that goes on either side of an issue. If interest rates turn out to be higher than we expected, we've got some companies that'll do well in that environment. If they turn out to be lower, the Fed cuts rates, we've got companies that'll do well in that environment. And it's not easy. That's where the numbers come in. You really have to analyze and understand. A lot of moving parts that you need to work with at the same time. But that's what we would call true fundamental diversification.
So Jason manages a good share of our clients' portfolios, and he uses individual stocks primarily to reach the goals. But he emphasized diversification in his comments here just a little bit ago. And it's absolutely critical that clients, we've had clients, I'm sure everybody has had this, where they emphasize some key stocks that they've bought way back when, and they've done really well over the last 2 or 3 years. But now they're realizing that concentration into just a handful of stocks can be really upsetting. And the question is, do they have the stomach to tolerate the volatility, right?
That's right. And we're in an unusual and interesting period of time. It used to be, and I think in the future it will be again, that having an index type portfolio, whatever you say about it, at least it's diversified.
Right.
As it turns out now, maybe it's not as diversified.
Well, going back to your concentration comment, right?
That's right. And so we can actually intentionally build a portfolio that is far more diversified, maybe not to your eyeballs necessarily in terms of the number of stocks, but in terms of the true underlying diversification. And that's really helped. We've really seen the benefit of that over the past 6 months, and especially this year. And that's still our focus. And I've got to think, especially for entrepreneurs, the sorts of folks you work with, their financial risk doesn't just come from their portfolio, or even primarily from the portfolio. All of these same things that affect the portfolio also affect their business. And so working with you to understand how that translates, and maybe there are some things we should do in the portfolios to kind of reflect this big business risk, that's invaluable.
Yeah. That's so great. We talk about real estate with a lot of our clients of how that is one more asset class, and often it's a useful one for people to have in their portfolios. But I really like your comment, Jason. Like if someone had a business and their investments reflected their business, and their real estate was maybe the real estate in their business, right? That there's not as much diversification. That if those were separated to say, hey, you're in this industry for your business, let's skew your stocks a little bit so that you're more invested in these types of the industry, or let's make sure your real estate's unrelated to your business. And how much of a more sturdy boat that could make, as they sail along, than trying to almost accidentally putting all your eggs in one basket. And I think that's kind of what the indexes did a little bit for folks. They accidentally started to put more and more eggs into these high growth baskets last year. And I think people perhaps didn't realize how concentrated they were getting.
Well, it's a mindset shift, right? Like Jason, I love how you approach that. You say, okay, we see such high concentration here. For those who are interested in the high performance, they're going to dive right in, jump into the deep end. But actually, your reflection of that is there's a lot of risk there, right? Because the S&P 500, the index models that we've typically have given us such broad diversification, lower level of risk, are actually riskier now in the current environment that we're in because there's such a concentration. And so having a different type of model constructed, so we're actually abroad. Now, we might give up a little bit of that high performance, but overall, if we bring down the risk of the portfolio, we're better served over the long term. And that's a mindset shift, right? Especially a lot of entrepreneurs are risk takers. They're willing to seek the higher return on the market for the risk that they'll bear as their financial advisor. We want to quarterback their long-term future, right? This is some of the conversations that we need to have. What's a wise investment, and how do we need to construct these models to look at this from a long-term perspective?
That's absolutely right, and I'm sure that what you're telling them is that your job is to protect their ability to continue to take financial risk in their business. That's where they're going to get the return, right? And so we can't load up on that same financial risk in the portfolio. We've got to actually take actions, and we do, to allow people to spend their risk. There's only so much they can spend. There's budget to spend their risk in the areas where it's going to do the most good.
Yeah, well said. I love how you said that. So, all right. So we've talked about some of the notable sectors driving kind of the bearish momentum. There's factors contributing to this volatility. I talked a little bit about the sprinkling on of the new administration, but there's other things as well, right? We're looking ahead to the tariffs being imposed. We've got federal policy shifts happening very quickly. We've still got inflationary concerns for several of our clients and others. So let's talk in general. What are some of the other factors that you're keeping an eye on when we're talking about volatility?
The policies, the fiscal policies certainly have the potential to slow the economy and possibly even tip it into recession. Now, nobody wants that. You would think that the administration would not want that right out of the gate. And maybe some of the comments have suggested that they were willing to take a little bit of pain in the markets and in the economy. Maybe that was more positioning and so forth. But it is something that we need to take into consideration. When you add on top of that inflation, and as we sit here today, on the 12th of March, we got a good inflation number this morning. But inflation, it had been looking like it was going up a bit. Started talking about the Fed raising rates again, which we thought we had put that to bed. And so, there's a lot to talk through. I think in the end, though, it's really hard to say. I mean, it's hard to predict these things during a normal environment. But when there's, the administration and it's feeling its way through these policies, it's even harder. And so, that gets back to diversification. And, I don't want to lose track of something you said earlier, Laura, which is making those changes in the portfolio and then thinking about the tax consequences.
Right.
You want to diversify, but is it worth paying the taxes now to do so? Or should you let it go a little bit longer? Maybe not all the gains are long term. And so there's some techniques that we use other than just selling that allow us to change the risk, the exposures in the portfolio, and working through that and understanding that with you guys, that can be very valuable.
And I think that my comment on that is that when I sit down with clients, Jason, what you've done a really good job on is creating a tax preferential return for the non-qualified accounts. So again, people are listening to me. That means accounts that are not in your retirement account. You're not your IRAs and 401ks. But if you get a rate of return that is consistently better, that you don't have to pay income taxes on, or your tax situation is much lower, you are going to do much better over the long haul if you can stay within that stream. And consistently from year to year, it's better to have a return, let's say like 6, 7, 8%, somewhere in that realm, that is not subject to income tax, and you're not whipshod every time you get a 1099 every year, saying, "Oh, I made all this money, but all of a sudden I've got to make all this." So managing the portfolio, it's not easy, because you're having to take care of portfolio structure. You're taking the long-term gains, like Jason alluded to it. Long-term capital gains is different than short-term capital gains. Then you mix that in with your losses. You're trying to balance out the portfolio and still maintain the diversification. This is the benefit that we provide to our clients through Jason's expertise and management style. So again, I've seen it again and again and again. Don't get too concentrated, and don't get what most people are they're blind to the tax ramifications until it hits them, right? Until all of a sudden they get this tax bill due. And what's really important is that you are on top of that ahead of time. I mean, it's a constant monitoring, I would say.
That's right. That's right. Well, thank you guys for hopping on here. This has been a great discussion. It's so robust, Jason. We appreciate you so much. Thank you for sharing your time and your thoughts. And for everyone else, thank you for listening to the episode. We'll catch you again next week.
Thanks.
Thanks, guys. Great seeing you.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit trichordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@trichordadvisors.com, or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Trichord Advisors, we are your future's best ally.